Good morning. Welcome to FLIA's Real Estate Direct Lending and Private Debt Forum, Part 12. We would like to thank our event sponsors, Preqin, PIA Residential, Boomerang Capital, Apex One Investment Partners, GSH Group, Sunstone Properties Trust, Ground Floor, Acre Trader, Preqin Industries, Masterworks.io, Highmore Capital, Tunningbill, Sheridan Asset Management, Encore Enterprises, CGI Merchant Group, JDM Capital Hospitality Management, and Zenith Storage. We'd also like to thank our sustaining members, First Lien Capital, Sunstone Property Trust, Mercadine Automated Properties, Allagash Partners, Apex One Investment Partners, Boomerang Capital, S&P Global Market Intelligence, Nationwide, Intrust Global, Off the Chain Capital, Robo Global, EMQQ, Sheridan Asset Management, Safe Harbor Equity, and Encore Enterprises. We'd also like to thank our FLIA board for their support during these challenging times. If you're not familiar with FLIA, FLIA is a 501c6 nonprofit organization that was started in 2007 with the goal to become the world's leading marketplace for alternative investments and alternative investments education. Since then, FLIA has helped thousands of firms in the capital raising process, aided in the allocation of billions of dollars to alternative investments, and we've leveraged technology to accelerate the due diligence process. Today, FLIA as an organization has approximately 11,000 members on the platform with over $5 trillion in discretionary AUM. As a reminder, Season 2, Part 1 of Real Estate Direct Lending and Private Debt Forum is upcoming April 15th, and our Artificial Intelligence, Blockchain, and Cryptocurrency Forum will be held on May 6th. Thank you for attending today and enjoy your day. Our first presenter this morning is Mr. Joseph Borda of Prequent. Topic today is Outlook for Private Debt and Real Estate. Joseph?
Joseph, the presentation looks great. You got to turn on your mic.
Great. Yep. Can you hear me now?
Yes, we can.
Great. Thank you all. And thank you, Dr. Knight and the FLIA team for having me speak at today's event. As mentioned, my name is Joe Borda, and I am the Senior VP of Research and Data Operations at Prequent. For those of you that don't know Prequent, Prequent is the home of alternatives. We are the leading source of data and intelligence for the alternative assets globally. We strive to provide the most accurate, timely, and comprehensive coverage for the industry, with one of our main goals being providing transparency to a rather opaque market. In times of uncertainty or instability, individuals are always looking for data to make informed decisions about their investments and their portfolios, and that's where Prequent comes in. Today's presentation will attempt to provide you with a high-level overview of the current private debt and real estate market. We'll look at 2020 year-end data, discuss some potential opportunities for 2021, and share key insight into the mind of the investor, sharing some results from our recent H1 2021 Investor Outlook Survey. Additionally, we'll look at some projections on where we expect the industry will grow by 2025. Through all of this, I'm hoping to shed some light on the following questions. How did private debt and real estate fare in 2020? What opportunities may exist in 2021 for the industry? What are and what do investor plans look like in the year ahead and over the longer term? And lastly, where do we expect to see growth within the industry come 2025? So to jump right in, this first section will be a high-level overview of private debt and real estate, targeting AUM, fundraising, and deal volume. Despite the economic slowdown triggered by the pandemic, global private capital AUM continued to climb, eclipsing 7.5 trillion as of June 2020 data, continuing the growth we have seen over the last 5 years. Compared to 2018 year-end data, the industry has experienced approximately a 25% increase in growth in AUM, with private debt and real estate asset classes experiencing 20% growth and 15% growth, respectively, in AUM. Private debt has emerged as a core asset class following the global financial crisis, and they have again proved its worth in a volatile year. As mentioned, we saw approximately a 20% increase in the asset class AUM since December 2018, making it the third largest asset class among private capital, only behind the likes of private equity and real estate when looking at industry AUM. In an ongoing low interest rate environment, investors continue to turn to private debt to diversify and generate strong returns. This increase in AUM has been driven by 2017 and 2018 vintage year funds, plus the continued trends of funds focusing on North American vehicles and opportunities, which account for approximately 61% of total AUM. With that said, other regions have gradually expanded their share, as shown in the graphic to the right of the screen. European-focused investments are now accounting for just under 30%, which is increased levels compared to the last 3 to 5 years. From a returns perspective, the asset class has displayed resilience, and investors are especially attracted by the potential high yield given the low return environment, as mentioned earlier. The stressed debt AUM in particular has experienced a significant injection of cash. Many businesses previously viewed as financially sound or defensive in nature have endured increasing financial stress during global lockdowns. Additionally, direct lending investments and opportunities continue to be a key reason for growth we are seeing within the asset class, as you can see a breakdown here on the graphic by private debt strategy type. Shifting to fundraising. Fundraising remained rather robust, although we did see a decrease in number of funds closed down to around 200 and an aggregate capital raised at around 118 billion, which was a decrease from 132 billion the year prior. We continue to see an intensification of capital concentration for these funds by both region and top tier managers. Compared to 2019 figures, we saw a 12 percentage point increase in aggregate capital targeting North America focused funds. Consolidation and concentration is not only coming at the regional level, but also fund level, as we saw a large number of mega funds raised from top tier managers in the space. 10 of the largest funds accounted for 39% of all capital raised in 2020, which is a 9% increase from 2019 figures. Of these, we saw a larger percentage of funds closing between 100% and 125% of their initial target size at the onset of the year. And 24% of these funds closed at either above 125% or above their initial target size, which is the largest we've seen since 2014. Although the logistics of fundraising and in-person meetings had to drastically change in 2020, the success of these fundraising efforts largely remained the same compared to previous years. The industry was able to adapt relatively quickly and efficiently. We saw a slight increase in the average number of months in market, as shown in the graphic here, up to about 18 months for those funds closed in 2020, with them achieving on average 105% of their initial target size. As mentioned, this capital continued to flow to top tier managers, with 39% of aggregate capital raised by those top 10 largest funds, and an additional 15% of aggregate capital raised coming from those funds ranked between 11 and 20 in size. At the other end of the spectrum, funds outside of the top 15 constituted for less than a quarter of all capital raised, which is slightly lower than we've seen in previous years. When looking at first-time fund managers, they did struggle a bit as investors favored their more established counterparts, and we saw a decline in the proportion of capital raised, as well as the number of funds closed. The desire for more established and experienced managers, combined with the difficulty of forming new relationships, did not help the very least. Despite all of this, the average size of first-time funds that closed in 2020 increased to its highest level on record, suggesting more capital is being shared amongst fewer first-time managers, as can be shown in the graphic to the right. As competition continues to increase, it will be ever more important for first-time fund managers to continue to differentiate themselves from the pack. Quickly highlighting deal volume and value, it's unsurprising that we continue to see a decline in debt issuance, although we did see the average deal size remain relatively stable in comparison. Volume rebounded in the second half of the year, and we saw various industries increasing in aggregate deal value when compared to 2019 results. Some of these industries including consumer discretionary and financial and insurance services. Two of the largest deals we saw in 2020 came from the transportation sector, an industry that some would argue suffered the most in 2020, and in particular, car rentals and airlines. We saw a deal involving Apollo and Hertz, and Oaktree and Latam Airs, which were high on the list in terms of deal size. Switching gears to real estate, despite the challenges in economic disruption and uncertainty that may have been specific to this asset class in 2020, we continue to see ample and a steady rise of demand for the asset class. AUM reached record levels, topping $1 trillion as of June 2020, which is up approximately 5% from December 2019 year-end figures. In a short time frame, the asset class has largely doubled over the last 8 years, and investors are continuing to target the asset class for stable income returns and portfolio diversification benefits. North American focused investments continue to be the driver of this AUM growth, although we have seen European focused investments in vehicles and their subsequent AUM increasing at a rate of approximately 10% year over year since 2015. North America AUM has risen by approximately 7% annually over the last 4 years or so. And when looking at the Asia Pac region, Asia-focused real estate AUM has remained relatively flat over the same period, which can be shown in the graphic to the left. The need for local expertise and participants may be seen as a potential barrier of entry for global investors within the Asian market. When looking at real estate specific strategies, opportunistic and value-added strategies remain key and important investment opportunities for the growth of industry AUM. In 2020, we saw distribution versus capital call trend change as net cash flows turned negative for the first time since 2012. Distributions and capital calls saw drastic declines as transactions decreased across the board. Some would say many real estate assets have not been repriced to the level where buyers are willing to transact and deploy capital, which is somewhat evident in our H1 2021 Investor Outlook Survey, where approximately 30% of investors surveyed felt pricing is currently overvalued and a correction is more than 12 months away, but needing a correction. As shown in this graphic, fundraising saw its worst year with regards to aggregate capital raised since 2013. The number of funds fell by 43% compared to 2019. And despite the significant decline in the number of funds, fortunately, the aggregate capital did not drop as sharply. This would generally showcase the same general trend that I mentioned earlier on the private debt side, where capital is increasingly concentrated to fewer but larger fund managers via some of their largest funds and some of the larger funds within the industry. No strategy or region was able to really mitigate a decrease in capital raised or the number of funds as shown on the previous graphic. But North American vehicles really experienced the largest decrease year over year at about 48% with regards to number of funds raised and about 40% in the aggregate capital. Relatively speaking, Europe saw the smallest impact on fundraising and aggregate capital, where they saw a 12% decrease in fund closures and 13% decrease in capital gained year over year. When looking at these funds that did close, they on average closed at a higher percentage relative to their initial target size at about 106%, being the highest we have seen on average over the last 10 or so years. Almost half, or 45%, secured more than their initial target, with about 20% seeing levels well above their initial target size at 125% or above. Unsurprisingly, the average time in market did slightly increase to about 18 months for those fund closed in 2020. Quickly looking at global private equity real estate deals, we saw approximately a 50% decrease in aggregate deal value in 2020, while the number of transactions fell by 39% year over year, as shown in this graphic. On these next two charts, we can see that all regions and sectors were largely left unscathed. In particular, office and residential experienced approximately 120 billion decrease in deal value compared to 2019. Hotel assets also faced some of the largest declines, with both transaction amount and value decreasing around 65% year over year. The continued emergence from regional lockdowns and willingness for international travel will be vital for the sector to recover in 2021. Shifting gears slightly a bit, I'd now like to touch on outlook for the asset classes and the investor plans and appetite for these two key industry areas. When looking at private debt fund managers are seeking record amounts of capital in response to the uptick in demand for yield.
Got it.
For yield driving allocations. Comparing figures at the start of the last 10 years, as of January 2021, there were 547 private debt funds in market, and these vehicles were seeking an aggregate of 209 billion in capital, which was an increase of 51% comparing year over year, comparing January 2020 to January 2021. Looking at February, end of February 2021 figures, we saw this number rise to approximately 567 funds in market, targeting approximately 297 billion. And then when looking at 2021 year-to-date figures, we're currently at around 588 funds in market, seeking around 308 billion in capital, approximately seeing an increase of about 40 funds and 18 billion in capital targeted since January 2020 figures, as shown on this graphic. Of these 500 plus funds in market, North America focused vehicles account for over half of all private debt funds in market, coming in at about 58%, up from 51% in 2020, which has really not shifted too much, as we have seen more funds and capital come to market in February and in March 2021. When looking at specific fund strategies, special situations have seen a significant increase year over year with regards to funds in market. As of January 2020, we saw 31 funds in market compared to 79 plus, which we have seen at the start of 2021. Special situations now account for 14% of all funds in market, although direct lending funds still dominate the market with almost half of all funds of those that are currently in market. As of January 2021, it was about 270 of the 500 plus funds in market. As more and more investors flock to the asset class, searching for stability and strong returns, the ratio of targeted capital to prior year capital raised has increased significantly from a multiple of about 1.45 or ratio to 2.46 in 2021. As we continue to progress throughout 2021, it will be interesting to come back to these figures and understand if all GPs have been able to meet their initial target sizes and at what rate. Shifting to real estate, for the first time ever, more than 1,050 funds are seeking commitments at the start of 2021. These vehicles are collectively aiming to raise approximately $310 billion from investors, also a record number for the industry. Fast forward to March year-to-date figures, we have not seen too much of a change in terms of funds in market, still above that 10,000 or 1,050 funds in market, but targeting approximately $330 billion in capital, so an increase there. As shown in the graphic, opportunistic and value-add strategies account for the majority of funds in market, although we have seen an additional shift and trend that may be emerging. This trend being an appetite for higher quality core real estate strategies where exposure to risk is minimal or controllable and income streams are more reliable. While core funds represent only 13% of private real estate funds in market, this strategy has witnessed one of the sharpest risers in the number of funds in market year over year. When looking at opportunistic funds, they account for about 30% of funds, but only about 26% of capital targeted. So on average, we could say that these funds can be seen as a bit smaller than those pursuing other strategies. Value-added funds account for approximately 31% of funds in market and just under 30% of capital targeted for 2021. Based on the recent fund manager surveys conducted in November 2020, we can see office, hotel, retail sectors are areas of interest for fund managers, and they'll actively they'll actively look to avoid at around 53% or 52% and 58% respectively. Alternatively, residential and industrial sectors are where about 80 to 90% of GP surveys will be looking to actively target, which are being seen as key investment opportunities for the space. When looking at investor appetite and attitudes towards alternatives as a whole, the overwhelming majority remain confident and optimistic in the space. Across all asset classes, investors stated they were satisfied with their performance over the past year, and a majority of investors across the board and across each asset classes said that their performance has either met or exceeded expectations. When looking at Preqin investor data set, approximately 65% of all LPs tracked allocate to real estate, and around 40% have exposure to private debt. And we have seen a steady increase in target and current allocation to those respective asset classes on a global scale over the past 5 years. As a whole, investors are planning to commit more capital to private debt and real estate than less over the next 12 months. When looking at private debt, it's specifically around 47%, and 36% in real estate are targeting more capital to these asset classes. Over the longer term, more than half of investors in the private capital and infrastructure plan to increase their longer term commitments, with just about 4% and 2% respectively planning to reduce their current investment levels. The early verdict from investors is that alternative assets have had a good crisis and will continue to deliver through the recovery phase. For private debt specifically, 48% of investors are looking to increase their allocation to private debt over the longer term, with only about 10% stating they were looking to decrease. More than half of those surveyed, about 56%, are backing distressed debt as an opportunity, seeking and a key investment opportunity, while there's about 48% seeing promise for special situations. Shifting to real estate, After a difficult year, investors remain confident and committed, with about 44% planning to increase or at least maintain their allocation to real estate. And the financial and operational challenges caused by the global pandemic have raised investors' expectations for distressed opportunities, as we can see in the graphic on the right. Of those LP and GP participants that were surveyed, most are largely aligned with regards to the areas of opportunities for real estate, which of course differing percentage levels across the board. To quickly highlight on these last 2-3 slides, I'd like to share some projections in the Prequin's Future of Alternatives reports that was released in December 2020, which takes a look at the market, industry trends, and the asset class between now and 2025. Private debt is expected to be one of the fastest growing asset classes, with AUM increasing at a CAGR of 11.4% over the next 5 years. Again, in this low interest rate environment, high single-digit returns will be attractive. Private debt total AUM has risen approximately 182% from $315 billion in 2010 to $887 billion in 2020, and we are projecting that to $1.4 trillion in 2025. For real estate, again, we are seeing growth, but at a somewhat slower rate, with a CAGR of around 3.4% per year. But this should be viewed in the context of a market hit by what will likely be a period of demand uncertainty for some of its largest sectors, retail and offices. Despite this, demand for real estate assets persists, and we are seeing continued confidence and commitment to real estate. As portrayed on previous slides, investors plan to increase exposure within their asset class to private debt and real estate by 2025. And then looking at ESG as a key trend, a majority of both fund managers and investors believe these policies have a positive impact on returns, with investor demand and the evolution of industry standards being key drivers to this space. The next step here is defining and making ESG objectively accountable, and efforts to standardize metrics and identify KPIs in ESG are continuing to be pushed. With the total number of impact funds falling in 2019 and 2020 relative to prior years, the assets invested in by funds actually have risen sharply, with the average size of 2020 vintage impact funds at around $1.3 billion, essentially doubling 2015 vintage years as shown in the graphic here. Just to end with some key takeaways and summaries from the presentation, AUM has, of course, continued to increase despite the turmoil and uncertainty that we experienced in 2020, with private capital AUM at around 7.9 trillion, and we are expecting and projecting this to grow to upwards of 17 trillion across all of alternatives by 2025, and more details can be found in Prequin's Future of Alternatives report there. Fundraising and deal flow suffered in 2020, but we are expecting to see a rebound and hoping for one. Investors remain confident and committed to alternatives over the short term and the longer term, as the majority of investors plan to increase their allocation rather than decrease. And ESG continues to be an important factor in the capital allocation game. Some key drivers being investor demand and the need for a competitive advantage for fund managers. So that wraps up the presentation. I just would like to thank everyone for my involvement and hope you found the presentation informative and insightful. All slides should be available for all attendees, but they can also be found on Prequin's website under our conferences and events portal. So thank you again to Flya and having me speak this morning.